Hi folks, and welcome back to Meaningful Money. Okay, I'm here again on Chapel Carn Brae, just about halfway up. Beautiful clear day though, so you can see nice shot behind me. Sort of towards that direction is St Just and Cape Cornwall, where I've been before. Behind the camera is it's roughly the village of St Buryan and Mounts Bay and all that. So nice spot. Freezing though, so I'm wrapped up warm with me scarf on. Sign of things to come in it though. Honestly, when I started doing these, I was in my shirt sleeves in glorious sunshine. And while the sunshine is still here, it's freezing. So we need to wrap up our taxation series here and talk about inheritance tax planning. The second part, we just covered the very basics last time, and I just want to put a bit more detail when it comes to giving your money away, because that's easy to say, but there's actually many ways you can do that. So I just want to cover in a bit more detail some of those things. Now, I mentioned the 7-year rule last time. 7-year rule was invented so that you couldn't sign all your property away on your deathbed and therefore pay no inheritance tax on it. The 7-year rule simply says that if you give something away and then die within 7 years, then the value of that gift is sort of added back into your estate when you die, and they do the sum to calculate the inheritance tax. Now, it works on a sliding scale. So let's say that I'm a very rich man. Let's just imagine that for a minute. Let's imagine I'm a very rich man, and I want to make a £100,000 gift to somebody. Now, this is to an individual, not to a charity, because charities are tax exempt. But I want to make a £100,000 gift, right? So I do that today. Now, if I die in the next 3 years, then the full amount of that 100 grand gift is added back into my estate. If I die in the 4th year, then 80% of that gift is counted back. In the 5th year, it's 60%. In the 6th year, it's 40%. In the 7th year, it's 20%. And then when I have lived the full 7 years, and I'm in the 8th year, or I die in the 8th year rather, then there's no tax to pay. The gift is deemed to have gone from my estate at last. So it's counted back in, but on a sliding scale. So it's important that we know that for calculating our tax. So if you've given a major gift, then you can, when you're working out how big your estate is for tax purposes, that calculation needs to be taken into account. So that's the 7-year rule and the sliding scale of adding back your gift back into your estate. We've mentioned twice actually now the various exemptions. You remember, these are sort of amounts you can give tax-free and to which that 7-year rule doesn't apply. So the £3,000 per year that everybody gets. The wedding exemptions, as many different gifts of £250 as possible, as you want rather, and then the important one, the gifts from income. So look back to last time, and I think episode 67 was inheritance tax, just to cover those off. Leave any questions in the comments, of course, if you've got them. Now, we also need to be careful, I mentioned it last time, of making a gift but reserving a benefit from what you give away. The easiest example of that is if I was to, say, give away my house to my children but continue to live in it. Well, the Inland Revenue would not consider that to have been a gift at all. So that doesn't work for inheritance tax. Just checking up the path, make sure nobody's coming. So the house is an obvious example, but maybe I've got a very valuable work of art, and I give that to my daughter, say, but it stays hanging on my wall, and I'm getting the benefit of having that art on my wall, but I don't own it anymore. Well, the revenue would just deem that I still own it. So we must be careful when making gifts, when giving money away, that we don't reserve a benefit from that gift. It's got to be given, gone, and I'll get no benefit from it anymore if it's going to work for inheritance tax purposes. So giving away is not as simple as it sounds, but it's probably one of the most effective strategies for inheritance tax planning. Just a couple of other things to bear in mind. First thing is something called business property relief. Now, this is a sort of a special exemption allowance, if you like, when it comes to inheritance tax, because if I own some business property, now I don't necessarily mean a business property, a building, but say some shares in a company which might qualify for this, then if I've owned that asset for 2 years, then it becomes completely free of inheritance tax should I die after that point. Now, there are schemes and plans set up specifically to take advantage of this relief. So, it may be that your advisor might have spoken to you about it. Hey, here is an investment which qualifies for business property relief. Hold it for 2 years, and that amount of money will be exempt from inheritance tax when you die. Now that's all well and good, but usually these kind of schemes invest in shares in smaller, more untested and more unregulated companies, usually shares listed on something called the AIM market, the alternative investment market. The golden rule, one of the golden rules is financial planning, is never do anything for tax reasons that you wouldn't ordinarily do. So don't do a risky investment just because it's tax efficient. It's better to sleep at night and be comfortable with the level of risk you're taking and pay a little more tax, in my opinion. Business property relief, though, is actually a brilliant way of reducing your inheritance tax bill. So perhaps speak to your advisor about schemes that take advantage of that. But be careful and make sure you understand the risks before you do. A couple of things finally. One is the use of trusts in inheritance tax planning. So there are some schemes which you may have heard of, things called discounted gift trusts or gift and loan trusts. These are schemes which your advisor can explain to you. Maybe I'll come back to them. I don't want particularly to go into too much detail here, but they're pretty powerful and they work. They can make a significant reduction in your inheritance tax bill, very often right from the outset, so they're worth considering. Different kind of trust-based, insurance-based schemes. And the last thing you can do, the third of our sort of strategies, is either spending all your money, giving it away, or insuring the liability. What you can do is add up your estate, take off the nil rate band, that's $325,000, bearing in mind whether you've got a spouse or not. But once you've worked out what your inheritance tax liability is, you could just take out a life insurance policy, a whole of life insurance policy, for the amount of your tax bill, put it into trust so that when you die, the insurance policy pays out, and that goes to your kids or whoever who pay the tax, and then they get your estate then in full. Now, when I speak to clients about this, some of them say, well, no, they're going to be very rich anyway, they can pay the tax, and maybe that's your view as well. But it is possible for you to take out a life insurance which will pay the inheritance tax bill in full when you die. So that's something just to bear in mind. But if you do that, obviously that policy needs to be paid and placed into trust. It can't still be in your estate. Otherwise, when you die, you're just going to make the problem worse by having the proceeds pay out into your estate, and you pay more tax on it. So that would be a bit daft. So we've sort of covered all the major taxes really, and some very, very basic things to think about when you're planning around them. The purpose of this website is not to be too technical. You need to get a good advisor if any of these things are pertinent to you, and make sure that advisor can explain these things fully. But if you have any questions, then leave them in the comments section as ever, or on the Facebook page, whatever, and I'll do my best to answer them. Next time I'm going to do just a one-off, and the title of the next one is simply, what is the deficit? A lot of talk about the deficit in the last couple of years. I want to explain what it is, what it means, and prepare to be terrified at the scale of debt we have in this country. So thanks very much for watching. From Chapel Cambrai, thanks, and I'll see you next time.